In 2012, JP Morgan measured the risk on one of its trading desks with a chain of Excel files. A man filled them in by hand. He copied the numbers out of one spreadsheet and pasted them into the next. And one of those formulas divided by a sum where it should have divided by an average. So the risk on that desk looked about half as big as it really was. You'd think losing $1 billion takes a genius. It doesn't. It takes an ordinary mistake nobody catches, held by somebody who can't afford to admit it yet. 10 of the worst traders who ever lived. Counting down. Number 10. It's the 20th of April, 2020, and a day trader in Ontario called Syed Shah is looking at oil. He doesn't normally trade oil. He trades stocks and currencies, where the worst thing that happens when you buy something for a penny is that you lose the penny. Oil was about to do something it had never done in the 37 years the contract had existed. Nobody was driving. The storage tanks in Oklahoma were nearly full. And anyone still holding a May contract had to find somebody willing to physically take 1,000 barrels of crude off them. So when the thing you own costs you money to get rid of, the price goes below zero. That's how you end up paying somebody to take your oil. Before he bought, Shah tried to place an order at a negative price. His broker's system refused it, so he took that as proof oil couldn't go below zero. He'd tested the one assumption everything rested on, and a broken system told him he was right. The software had a second problem. When you open a contract, the deposit you post is capped at whatever that contract is nominally worth. So as the price fell towards zero, so did the deposit. Interactive Brokers asked him for $30 a contract. Its own internal requirement that day was $8,462. At 11 minutes past 2, 3 minutes after oil first printed below zero, his screen said 1 cent. He bought 212 contracts. Oil was actually at minus $3.70. It settled that afternoon at minus $37.63. He didn't find out overnight. He spent the evening on the phone to support, trying to work out what his account was doing, because the same broken feed meant the automatic liquidation that should have closed him out never saw a problem. The statement arrived around midnight. The loss was printed in scientific notation because the number was too long for the field. He owed about $9 million on a $77,000 account, and it took until July to negotiate the debt away. Interactive Brokers paid out $102.7 million to customers and got fined over the failures. And Shah's own verdict? The trade should never have been processed at all. Number 9. In October 2019, a Robinhood user found a hole in the app. The hole was one subtraction the software never did. Say you own 100 shares. You sell somebody the right to buy them off you at almost nothing, and they hand you nearly the full value of those shares in cash today because you've just promised the shares away. That's a normal trade. But Robinhood credited you the cash and carried on counting the shares as yours as well. You've been paid for them and you've still got them. So you could do it again with the money it had just given you. And then again. He turned about $2,000 into roughly $50,000 of buying power. And he put it into Apple puts, which pay out if Apple falls. Apple reported earnings after the close on the 30th of October and beat. $3.03 a share against $2.83 expected. Record services revenue. Holiday guidance above what analysts had asked for. The stock closed that day at $243.26 and opened the next morning at $247.24. He filmed himself watching the market open. 34 minutes later, he posted the video. Under the title, "I recorded today's market open and the instant delta to my portfolio." The account is gone. The original upload is gone. The noise isn't. It's now the word that entire subreddit uses for a loss too large to describe. Robinhood restricted the accounts within days, said it had made a permanent change to stop anyone trading that pattern again, and told Bloomberg its total losses across everybody who ran the trick came to under $100,000. So the exploit that produced the most famous sound in retail trading cost the company less than a used car. If you want more of these, subscribing is the whole favor I'm asking. Number 8. 3 months later, on the same app, a user called 1R0NYMAN found something better. And this one wasn't a bug. It was real, it was legal, and he was right about it. So what's a box spread? It's 4 options arranged so that whatever the stock does, you owe one fixed amount on expiry day. It isn't a bet. It's a loan with a known repayment. He took in $297,000 up front, and he'd owe $250,000 of it in 2 years. That's $47,000 for doing nothing. He posted the position to Reddit. And when somebody questioned it, he wrote back that it literally could not go tits up because his maximum loss was $500 a spread and he'd been paid $594. The arithmetic was correct. The problem was the word expiry. American options can be exercised by the other side whenever they feel like it, not just at the end. He was short call options struck at $10 on a stock trading at $65, and that stock was expensive to borrow. So if you're holding the other side of that, exercising immediately is free money. The next morning they did. One leg of the 4 came out, and the fixed amount he was guaranteed to owe stopped being fixed. He'd already taken $10,000 out of the account on the day he opened the trade. His final balance was minus $57,989.57. Robinhood closed the account. Robinhood banned box spreads for every customer on the platform inside about 40 hours, before it had even finished unwinding his position. And the help page explaining why still describes a risk that wasn't the one that got him. Number 7. Robert Citron was the elected treasurer of Orange County, California, and for 2 decades he was very good at it. He ran the pool of cash that paid for the schools, the fire service, and the roads, and he consistently returned more than every neighboring county, which is why cities outside his own started voluntarily putting their money in. So how was he doing it? Leverage. You borrow against what you already hold, and then you do it again. He took $7.6 billion of deposits and borrowed against them until he was holding $20.6 billion of bonds, all structured to pay more as long as interest rates stayed low. In 1994, his opponent in the treasurer's election wrote to the county board, in writing, with numbers, calling the portfolio a bull market bet in the middle of a bear market. The voters read that and re-elected Citron 61-39. The Federal Reserve raised rates 6 times that year. 6 days before the county filed for bankruptcy, his assistant treasurer was recorded telling Morgan Stanley, "We do not have losses. We have not taken losses." On the same call, he explained that the bonds were down 7%, which with their leverage meant about 20. $1.64 billion, the largest municipal bankruptcy in American history to that point. And where had Citron's interest rate predictions been coming from? In a crisis meeting that December, according to grand jury testimony from the county's former finance director, the assistant treasurer told the room, a mail-order astrologer, and a psychic. He was never charged with losing the money. The 6 felonies he pleaded guilty to were for quietly moving about $90 million of interest that belonged to the schools and the cities into a county account instead. He was sentenced to a year. He served it on work, furlough, doing days in the jail commissary and going home at night, and he was out after about 9 months. Number 6. Brian Hunter traded natural gas at Deutsche Bank until his desk lost about $51 million in a week, so they moved him off it. He sued them for his bonus, and he lost. The court granted Deutsche Bank's summary judgment. A hedge fund called Amaranth hired him anyway, and after a rival tried to poach him, they gave him 15% of whatever his own trading made. In 2005, Hurricanes Katrina and Rita took out Gulf production, gas spiked, and that 15% was worth something close to $100 million. So what was he actually betting on? Not gas. The gap between 2 specific months, March and April of the following year, the last month of winter and the first month of spring. That trade has a nickname on the desks that run it. They call it the widowmaker. And he wasn't hiding. By August 2006, he held 63% of the open interest in one contract, and the exchange told him in writing that this was unacceptable. So he reduced it on that exchange and rebuilt the same position on a different one. On the 17th of September, a rival trader emailed him an offer for the spread and added that the only reason it was still priced where it was Hunter's own position. Hunter turned the offer down. Within days, the spread collapsed. And because he owned most of it, there was nobody left to sell to. $6.6 billion. $4.6 billion of it inside 1 week. Amaranth tried to hand the book to JP Morgan, then sold it to Citadel and JP Morgan at a further loss, and the fund closed. Regulators later fined Hunter $30 million, and a federal appeals court threw the fine out on the grounds that the agency had no authority over futures manipulation in the first place. He never paid it. Number 5. Navinder Sarao traded from his childhood bedroom in his parents' house in Hounslow, and over his career he made about $70 million. The government's position was that roughly $13 million of that came from cheating. So what was the cheating? A program that placed enormous sell orders he never intended to fill. If you were watching the order book, you saw a wall of sellers about to land on you. Then it moved them out of the way whenever the price came close. On the 6th of May 2010, it ran for 4 hours and 25 minutes, holding around 6 sell orders averaging 2,600 contracts each. Those orders were modified more than 81,000 times that day. 81 contracts were ever actually filled. He switched the program off at 12 seconds past 1:40 in the afternoon, Chicago time. The flash crash began at 1:41. Whether he caused it isn't settled, and the strongest evidence for the doubt comes from the prosecution. In the sentencing memorandum the government filed about him, the word flash doesn't appear once. Then there's the money. He handed roughly £40 million to 3 investment companies, and all 3 were frauds. One was a Ponzi scheme. One was a wind farm that never built a windmill. One was an online gambling company that went into liquidation. So the man who reverse engineered the order queue of the largest futures exchange in the world got cleaned out by people selling him a wind turbine that didn't exist. One of them thanked him with a framed Lionel Messi shirt. The signature on it is real. The words to Nav, written above it, are in different handwriting. He returned everything he had left, cooperated with the government for years, and testified against another defendant. In 2020, he was sentenced to time served and a year of home incarceration at his parents' house. So he was sentenced back into the bedroom. Number 4. In 2012, a JP Morgan trader in London named Bruno Iksil was told to reduce the risk on his book. Closing the positions would have cost around $500 million in real money. But adding new positions that pointed the other way made the net risk number shrink for free. So he bought more. The book went from $51 billion at the end of 2011 to $157 billion 3 months later. And the risk model that was supposed to notice? That's the hand-filled spreadsheet from the start of this video. It got large enough that hedge funds on the other side worked out what it was and started trading against him, which is when they gave him the nickname. Publicly, he was the London Whale. On rival desks, he was Voldemort, because the position was too big to name. When the first reports appeared, Jamie Dimon called it a complete tempest in a teapot. 27 days later, he described the same trade as flawed, complex, poorly reviewed, poorly executed, and poorly monitored. Unwinding it cost $6.2 billion, and the bank paid about $920 million in fines. Iksil was never charged. He cooperated, he was covered by an immunity arrangement, and the British regulator dropped its case against him. 2 of his colleagues were indicted instead, and neither ever stood trial, because Spain declined to extradite one of them and the case eventually fell apart. The government dropped all charges in 2017. Number 3. Jerome Kerviel had worked in Societe Generale's back office before he moved to the trading floor, so he knew which controls fired, when they fired, and what would satisfy them. And he hid his real positions behind fake offsetting trades that he canceled and re-entered before anyone checked. By the end of 2007, he was 1.4 billion euros up on trades the bank didn't know about. That's around half the profit of its entire equity business. He declared 55 million. He told police afterwards that he was pleased and proud of himself and didn't know how to justify it. And that's the part everyone gets wrong. He wasn't covering a loss. He was hiding a win. And he couldn't stop, because stopping meant explaining. In January 2008, he went long, 50 billion euros of positions, against a bank whose entire market value was about 36 billion. That position existed for 17 trading days. The bank noticed. Societe Generale's own internal review counted 74 alerts about his trading, 39 of them directly linked to the fraud. Everyone was raised, and everyone was closed. When they found it that January, they unwound the whole position into a falling market over 3 days, which cost 6.4 billion euros. Net of the profit he was already sitting on, the loss came to 4,915,610,154 euros, and the court ordered him to repay all of it personally. So he went to Rome to see the Pope. Then he walked home, 1,400 kilometers on foot, in protest at what he called the tyranny of the markets. 2 plainclothes officers arrested him at 1 minute past midnight, minutes after he crossed back into France. In 2016, an appeal court reconsidered the money. It found that the bank's own repeated failures had played a major and decisive role in what happened, and it cut what he personally owed from 4.9 billion euros to 1 million. Number 2. Bill Hwang ran a family office called Archegos, and the reason nobody saw him coming is that he didn't technically own anything. So how do you hold half a company without anyone knowing? Swaps. The bank buys the shares, and you take the profit and the loss. The bank's name goes on the share register and yours doesn't, so you file nothing, and nobody can see you. He did this at about a dozen banks at once, and no bank could see any book but its own. $36 billion of his own capital was carrying $160 billion of exposure. He was concentrated in a handful of names, and in one of them, he held swap exposure to more than half the company. His own buying pushed Viacom CBS up 150% in under 3 months, which is what killed him. The company looked at its own share price, decided this was an excellent moment to sell some stock, and announced a $3 billion share offering. The price fell. The banks called for margin. And when a bank calls you for margin, you have hours, not days. He didn't have it. His capital dropped 48% on the Wednesday, and another 46% on the Thursday. And in the middle of it, a junior employee who'd been told to request $470 million back from Goldman Sachs sent $470 million to Goldman Sachs instead. Goldman kept it. Goldman and Morgan Stanley sold first and got out. Credit Suisse moved last and lost $5.5 billion from a client who generated it $16 million of revenue the year before. That's a loss roughly 340 times the entire annual value of the relationship, and the bank didn't survive it. The judge who later sentenced Hwang put it in a court order. The scheme contributed to the failure of one major bank. He was convicted on 10 counts, sentenced to 18 years, and ordered to pay $9,408,886 $841,410.05. The court's schedule for collecting it includes selling his houses and using best efforts to sell a Ford Bronco. He hasn't served any of the 18 years. He's free on bail while he appeals, and he's applied for a presidential pardon. Number 1. Nick Leeson, Barings Bank, 1995. So who checked Leeson's trades? Leeson. Barings sent him to Singapore to run the trading desk, and also, because it was cheaper, to run the back office that checked the trading desk. He wrote the trades, and he wrote the record of the trades. And 8 days after he opened an error account numbered 88,888, he had the settlement software changed so that account was simply left out of the reports that went to London. He was supposed to be arbitraging tiny price differences between two exchanges, which is nearly risk-free and nearly profitless. What he was actually doing was selling options on the Nikkei. That pays you a small premium every time, as long as the index stays roughly still. And it costs you everything the day it doesn't. On the 17th of January 1995, an earthquake struck Kobe and killed more than 6,000 people. The Nikkei fell hard, and the options he'd sold went badly wrong. So he bought Nikkei futures, in size, trying to hold the index up on his own. And because he ran the back office, he could ask London for the money to fund it, and then verify to London what the money was for. They wired $835 million to Singapore across January and February against a bank whose total capital was around £350 million. By the 23rd of February, he was long 61,039 Nikkei futures, 49% of the entire contract. Barings' own books in London showed him short 30,112 and perfectly hedged. The reported position and the real position were mirror images of each other. 2 days later, he ran. He left a note on his desk that said, "I'm sorry," flew to Malaysia, and woke up in a hotel to find the newspaper pushed under his door. The front page read, "British Bank Collapses." He'd turned 28 the day before. The concealed losses came to £827 million, about $927 million once every position was closed out. Barings had been trading since 1762. It was sold to a Dutch bank for £1. German police arrested him at Frankfurt Airport. He served about 4 years of a 6.5-year sentence in Changi Prison in Singapore, wrote a book that became a film with Ewan McGregor, and then became the chief executive of an Irish football club. So you'd expect the lesson here to be discipline, or risk management, or not doubling down. But look at what was actually standing between these people and the money. A spreadsheet somebody filled in by hand, an astrologer, a margin system that asked for $30. Societe Generale raised 74 separate alerts about Kerviel and closed every one of them. And most of them are fine. One runs a football club. One walked to Rome and had his bill cut from 4.9 billion euros to 1 million. One had his fine thrown out and never paid it. One was never charged with anything at all. And the man who lost the most money in the history of one person losing money is at home, appealing, waiting on a pardon. So what do they have in common? It isn't greed. It's the point where the loss gets big enough that admitting it becomes impossible, so the only move left is a bigger bet. Kerviel couldn't explain a profit. Leeson couldn't explain an error account. Neither of them started out trying to destroy a bank. Both of them did. So tell me which one was worst, because I can't choose between the astrologer and the wind farm. Subscribe.